Hey YouTube, this is Zach with Achilles Financial. Today we're going to be talking about the four major banks here in the United States with Bank of America, Wells Fargo, Citigroup, and JP Chase, all of which are going to be announcing earnings this week. The reason why I think that that's super important is because we've gotten a lot of news that directly impacts the banks over the past 2 weeks, and I'm anticipating that we're going to continue to see more through earnings, including specifically what they're forecasting revenue-wise. As you can see, the banks had a very strong Q1, which was mostly driven primarily by share buybacks, driving the EPS up, as well as they were continuing to do very well when it came to trading fees. The key way that banks make money has been primarily off interest income, which has not been going up lately. So the big concern here, I'll break it down to the income statement. The big concern is that we're seeing a decline in interest and fees on loans. Primarily, if we look at the annual year over year, you can see the interest has declined from 2019 to 2020. There are a large reason for that being that we saw a huge decrease in interest rates here in the United States. So going forward, what can we expect when it comes to the actual interest rates in the United States? Well, there's no indication that prior to 2022 we're going to see any increase in the interest rates, which is obviously going to hurt banks when it comes to what they're making on the back end. However, we did also see a huge decrease in the expenses that banks had, especially the non-interest expense, which was primarily driving what it would take to go out and to repo a car, foreclose on a home, and go through the proceedings that would occur on commercial properties. So they saw a decrease in income for their primary line, but they also saw a decrease in expense for one of their key expenses. However, you are continuing to see a increase or an elevated level when it comes to the loan loss provision for financial institutions, driven by the fact that they do believe that there are losses in their portfolio that have mostly been delayed due to government stimulus efforts. So the big question here is, what are the banks going to be forecasting going forward? The big thing that I am going to be looking at is these banks and financial institutions have largely been decreasing their shares outstanding by doing these huge buyback programs. We also saw a number of dividend increases. Both Bank of America as well as Morgan Stanley had substantial dividend increases, and I'd like to see if that is going to occur with JP Chase as well. However, the big thing is they are reducing outstanding shares, which means that the EPS will go up year over year as long as these metrics stay the same, just due to the fact that there are less shares out there outstanding. Again, EPS standing for earnings per share. So if we look at some of the peer comparisons, recognizing that this is not the immediate or the last observable data, you can see here data for the fundamentals down below as of March 31st, 2021, and up here the summary data is as of July 9th, 2021. So the big thing that we want to note is that they have gone up incredibly so over the past year. So last year we were just coming out of the worst of the COVID shutdowns, and now we're starting to see the stock price has gone up significantly, as well as the market cap, especially for some of these institutions like Bank of America, JP Morgan. The dividend yield has declined in both of these stocks, but the PE ratios have gone up exponentially. The one that somewhat concerns me is Bank of America. Traditionally or historically speaking, a PE ratio in the banking sector that was targeted was right at 12. So you can see JP Morgan is right there. However, we're not seeing quite the same for Bank of America. So again, all the stocks have done really well, but we did see a decline in prices last week that was primarily driven by a decline in the 10-year yield and bond rates, which tends to signify strength in the US economy. However, the backside of that is, if there's not a lot of strength in the economy, people are expecting more monetary easing or quantitative easing, which would cause stock valuations to go up due to inflation concerns. But what we're watching here, we saw that decline and then a very strong recovery on Friday as the 10-year bounced a little bit. But the thing that we need to look at going forward that could benefit stocks, or rather banking stocks, due to the interest rates, would be the fact that the interest rates have the potential to go up. However, you can see that banks have kind of been hanging around this key level. This brought us back to April of this year. Notably, again, they did rise up prior to that with the rise in bond yields, causing stocks to continue to grow. But banks have been on an absolute tear this year, and for earnings, they're going to have to talk about a few key items, notably what their expectation for interest rate going forward. Second, what they see from an loss perspective in terms on loan losses, are they starting to see that occur, especially since we're going to see evictions and foreclosures become more prominent in the latter half of this year? And the other thing that we're going to be looking at is additional share buyback approaches. So the stocks that I'm going to continue to watch, I'll go to the peer comparison. The one that I personally just do not like, they continue to have trouble, is going to be Wells Fargo, WFC. However, the two staples in my portfolio that I really like is Bank of America and JP Chase, as well as the fact that I think Citi is kind of the outstanding one that has a lot of potential to grow. You can see the 52-week change. They have not gone up as quick due to a number of errors associated with their bank as a whole and a few slaps on the wrist from regulators, as well as you can see their dividend is still pretty high comparatively, so you can get paid to hold. And like I said, banks like to have that 12 PE ratio on a trailing 12-month basis, and they are lacking a lot of the other banks in this grouping. So for that reason, that's why I like them as a potential runner. But again, just to highlight, there is a lot going to be on this week, and what we want to look for is buyback news, dividend increase news, their loan loss provision expectations, and the forecast on interest rates. So that's what I'm going to be watching this year, or this earnings cycle. I will be following it and talking about it in the Discord, which is linked in the description down below. So let me know if you find this content helpful by leaving a like or subscribe. Thanks for watching this far. Talk to you later.